All right, guys, so we're gonna look at that last assignment that I sent and make it a group activity instead of just individual activity. You could always study more instances like this on your own. So first, let's start with M5 chart. What's this? Something written over here. What's that? Oh, that was something else. All right, never mind that. Zoom up. Let's find midnight. Which is that too far back? No, it's not. It's midnight. And let's take a look at the times that we had mentioned. The first one was, let's mute everyone. First one was this 5:20 a.m. Next one was 7:20, and then the 9:30 by. So the assignment was to take a look at the price starting here, look at delivery, and try to find the reasons for these entries right here, and targets, logical targets, logical entries. So I'm not sure if you guys have started, but based on this delivery, we can see that price has been, let's call this the buy side of the curve right here. I'm gonna call that the sell side there. So on this side of the curve, if you're looking at this portion of price action, most persons tend to only focus on structure here, higher highs, higher lows, that type of thing, and then try to buy retracements. But I want you to change your focus when you're looking at, let's say, buy sides of the curves, for instance. I want you to start looking here and look at where did the accumulation start and when was the first stop hunt in the push higher. When you find these things, you get a wealth of information from the price action. So most of what we're going to talk about today are stuff that you guys would have been already familiar with, like the fact that we have, that's the opening price right there at midnight. Here's accumulation. This is the first time price run low. In this to here, that price leg right there, just put the arrow. Let's put a thumbs up sign right there. This is the first stop hunt after the accumulation. So after midnight, this is the first stop hunt, which makes this right here what? Anybody can answer. This range from here to here, what's this?
A dealing range.
Dealing range, perfect. So if this is the dealing range, right there, the most important things of any range are what? Once you find a range, what are the next things that should jump out at you that I need to know where these things are in the range?
High-low equilibrium.
High-low equilibrium.
And highest up close candle and lowest down close candle.
Perfect. So there's our range. Just adjust it so it looks pretty. Range equilibrium, stack that with this line right here. So that's our range equilibrium. Let's take this. If that's our range equilibrium, our highest closing up candle would have been this one right here. Our lowest closing down candle would have been this one right here. All right. Now, once you have the dealing range formed and you've identified these levels, let's tag this one opening price. This down candle here is way more important to me than this up candle here. The reason for that, let's put it up here. Anyone want to guess what the reason for that is? Logically, not just because it's hindsight. Why would you be looking at this instead of this?
because the order block is the stop hunt was to the downside, and then it went to the other side.
Perfect.
So meaning that's a bullish order block.
Perfect. Perfect. So the dealing range was created after we had our run lower, and this is the last down candle or the lowest closing down candle before an impulse that broke above these highs. At this point in time, when the range has been created, everything before, including the accumulation, is inside the range. Meaning from this portion in time, or this price in time to that price in time, all of these candles are inside the high of this and the low of this range. So we are still inside the range. If the market's trading in a range, even if it's not consolidating, if it's trading within a range, automatically we should be able to frame trade ideas going from premium to discount, discount to premium, until the market breaks out. We never know which side is going to break out. Well, we do sometimes. But in this case right here, there are some things that are more trustworthy in this setup, which is why this up candle, I would not be looking at this up candle. It has absolutely no significance for a trade idea right now, because nothing happened that's significant from this price level as yet. But this price level, we can see this down candle created that push. Now that the range is created, I don't want you guys to start seeing a dealing range created and interpret this as a market structure break or a market structure shift. When the range is created, it's just the range being created. Since the accumulation was here and the stop point was to the downside, you don't need anybody to tell you that this is bullish. Nobody should have to tell you that this is bullish. It should be the first thing or the first idea that you get. Market accumulated, then I had a stop onto the downside, and then we ran higher, broke above previous structure. This market is showing me bullish tendencies. Let's call it that. I don't want to say trend. Bullish tendencies. That information gives you your initial assumption to start looking at what to expect after this time right here, which would have been 1:55 a.m. All right. So once we have that, you're now thinking, if my assumption is correct and this market is bullish, what are some of the things that I can expect? Well, we have an order block here. There's no fair value gaps around this order block. Notice that? So it would not necessarily be the smartest thing in the world to anticipate price going all the way back down to this order block, then going higher. And you know that I'm saying it makes sense when you hear it, but that's how I want you to see the price action. Don't just look at stuff and then just because you've seen OTE before, or you're seeing FVGs before, or you're seeing an order block before, means you're going to demand that price trades there. It must be logical, all right? So the logical things about this is our dealing range. We can see that the run started below midnight open. That already is fair valuation at or below midnight, classic ICT definition. The order block is all the way down here, but there is no FVGs inside here, or is there? There is no FVGs that I'm seeing, but I think this one looks like one. It is. So precedence is not on that order block, but on that high, and that candle's low. That's our FVG. It's also inside the high of this candle, all right? So this is a scenario based on this delivery that I don't have to expect price to trade back to the opening price, but I can start getting an entry at or just below the high, ideally inside FVGs. So here's our range. This trade is right at midnight open. Is it the perfect scenario? No. But what are you going to be risking if you entered at the opening price? 10 points? I don't think that's a lot of pips to risk. Yes, we can refine it, but the narrative here is that we're bullish, price trades down. I see no reason to go down here on a closing basis. So this candle right here could have easily just wicked down here and then moved away. So we don't need to see candles closing below this area. So most persons, myself included, would want to get an entry right here. I want you to get comfortable with the idea that price not closing below here is fine by me. So if I'm going to enter here, I'm going to factor this in as my stop. Worst case scenario. Why? Because the market can wick into this. So I'm not going to put my stop below this FVG. Put my stop below here. If I don't want to do that, we already know we're going to be using the zoom model entries from over here. Accumulation right here. This is the lowest closing down candle. That opening price would have been very ideal. On an eyeball basis, if that's a thing, it looks like it overlapped perfectly with that FEG. I don't want to put too many lines on the chart. So when you are analyzing this price action, you can put that opening price on and see how it all plays together. I deliberately went on the assumption that you guys missed this trade because it's not everything we want in a trade idea. Because I know that most persons don't look at the fact that this is now a breaker, since there was a stop point. I know that most persons are not going to be looking at that. We're going to be trying to get this entry right here. So my assumption is that this would have missed some persons. All right. But take a look at it again. Look at the dealing range. Dealing range is created. That red line is our 50% level. Everything or any array below that red line should be okay for an entry. If it's too close to the red line, cut your lot size and then hold it for longer. But again, for precision purposes, that's what we'll be looking for. The point of this is most times we see this run here and we interpret it as a market structure break and we automatically try to buy retracements. I want you to recognize the dealing range when it's formed and don't force yourself to commit to the dealing range. Just recognize it is a dealing range. What's price doing inside this dealing range? The first retracement went below 50%. Then we had price trading higher and took out the high. Now the dealing range high has been broken. See that? So price is now creating highs, lows, higher highs. We're pushing higher. So again, assumption was bullish. Price is supporting the bullish idea by not violating your bullish arrays in discount. No reason to not go long here. When you were thinking of going long here, even if you miss these entries, you're starting to look at the FVGs created in these expansions. Whenever there's an expansion, there's an FVG. Watch if retracements are completely destroying those FVGs. If they are, then you just sit it out. Don't do anything. So if we take a look at this right here is a FVG. We're closing below it right here, which means I'm not interested in buying this. Full stop. So I didn't try to have you guys look at hindsight and form fit a trade idea around these levels because it's easy to do that in hindsight, but you want to be looking at logical stuff. Very, very logical processes when you're doing your analysis, both hindsight and live, and that keeps you on the right track, in my opinion. So let's get rid of that FVG for now. Price trades up, creates a high, runs that high, then the high that runs the high stays intact for a while. This here is not the dealing range. or I'm not looking at this as a dealing range. Because by definition, I'm not seeing that structure here, which means I'm now looking at this high to a run lower that takes failure swings inside here. I'm not looking at this low being run out. Doesn't need to be for me. I just need to see those get taken. Why this and not this? Because when I see lows like this, I'm interpreting the failure swings to be the one that holds liquidity. So this is a run on.
Fish, wouldn't it be the like for me, I'd look at the small doji right after the black one.
Small doji right after the black one. That would have been
that one right there. Yep, that one.
This one?
Next one.
This one?
Next one, next one, next one. There you go.
This one here?
Yeah.
Well, we can look at all the lows to just to be precise. I was using my eyeballs. Yeah, this low looks like it went below here, but why guess when we can find out? I think Mishak said if I hover over this candle, it shows the low, 108.1, and this one is 108.2. So this did go below here. So taking this low is enough for a market structure shift and a dealing range being created, in my opinion. It doesn't invalidate what we're looking for since they all came down here. But what that gives us now, let's zoom out a little. Is that range. This range is the same as this range here by definition. So we can do the same analysis process. Fib the high to the low, tag 50% right there. Let's get the fib off. And now I can start looking at arrays for going short at or above that line. Here's our FVG when price was running higher. We close below. On this candle. So this is that shift right there. I'm gonna take this line off now since we all know why it was there. That shift created a FVG right here. So this FVG by definition is now a premium FVG. It's above 50%. It's occurring when an impulse is taking place. There's an order block that started to move lower. Everything about this opening price is high probability. Clear for everyone?
Yeah.
Maybe not. Okay. So this short, even though it's not, let me go to a 1 minute chart, you'll see what I'm talking about. Even though this short is not 100% textbook, from a narrative basis, this short is okay. If you take a look at this fractal inside here, up candle, impulse, FVG, below a low. Up candle, impulse, FVG, below a low. Same signature inside here. Which makes this a very, very early entry. If you miss that entry, you now have a narrative that says price could reject here if it comes back. This could be it, and then it just screams low, and that's the end of the day. But from here, we're seeing short-term highs. Took this short right here. We're seeing short-term highs being created below, not just this order block here, but below. Okay, cool. Oh, 8:30, 9:30. You're shorted at 9:30. We look at the 9:30 short in a second. We're seeing highs being created below equilibrium. This has to be liquidity. If we have a range, well, the range hadn't been created as yet. So let's keep that part out for now. We have the impulse. We have the logical level that price could fill in all of that void. Liquidity above the high, price moves low. These highs are now in the discount end of the range from here to here at this point in time, which makes this, I don't want to call it inducement, but let's call it inducement. Inducement. Because these are liquidity levels that are resting in the path of a logical retracement. So if you put your stop here, you're asking for it to get taken. When you put in your stop in a structure like this, you look at what made you bearish and what would make you feel bullish about the price action. I'd feel bullish if price was closing above here. So my stop goes above here. That makes it easy to manage when price is doing this, going back up here based on your spreads. You will know just how much above here you should put your stop when you factor in spreads and all this lovely stuff right here. So that's your short. This short is happening at 7:20 a.m. So this is that New York Judas. There's no reason here that I can see why price would want to go higher. There's no imbalances. There's no obvious areas of liquidity that the market could grab. So once it hits here, I'm thinking low. We've already run below here already, right? So I'm looking for all the imbalances that were created before this point, all the way down here. Those could be logical targets. I'm looking at failure swings created before that point. That could also be logical targets. All right, nice. Someone in the chat had the same narrative. Same narrative, yeah. That's how I see it. So that this short here, once we enter now and we see this up candle, we should start looking at the deliver after our entry if we're watching the price action. Some of the things that we would expect is once we close below here, I don't want to see price coming back. Retracements, yes, but then low. Once we get below the dealing range, I want to see order pairing, because this is where the liquidity would have been resting. Once we took it here on that sweep, once it gets back to an area of old order flow or old liquidity, I want to see what the plan is. So sometime before we were buying here on retracements. Are we buying here again? I watched this candle, the candle that's going below the lows. All of that is as high as I expect price to return to. This right here is the 50% of our old dealing range. Let's zoom out for clarity. 50% of our old dealing range, right? So a target from here to here, perfectly fine. What time is this? It's before 9:30. So if you get an objective in price that happens before 9:30, that should be a rule. Sit on my hands and do nothing. Because expecting lower prices from here, while it can happen because we can see that there are open gaps inside here, why would I want to subject all of my profit from here? That's, I mean, 50 points on Nasdaq on a daily basis is breathtaking. Breathtaking. So why would I want to risk all of this open at 9:30 when I know at 9:30 does a lot of times? Exit here, or at least most of the partials have to be off here as we're going inside this range, because this could be retracement, then I run higher. Don't expect price to go below here because there's no reason to. Runs below lows are grabbing liquidity. So stop run.
El Kish. Kish.
Can you hear me?
Yeah. You can hear me?
Yeah, I can hear you.
So at that low where the thumbs up is, yeah, right there. Would you consider that a stop hunt?
Yeah, this is a stop hunt.
Okay. I was looking at that.
So the failure swings after would have been the entry. So that confluence plus the logic from the dealing range all says get out right there. 9:30, market sweeps these, then runs higher. Where is it likely to run from here? Failure swings created before, let's even use here. All right, so see that run? Logical failure swing. I don't need it to go above here. Doesn't matter if it does, because I'm looking to enter and exit here. Gives us more, and most of us butchered this on a lower time frame. It was the same fractal. Now I got a lot of questions about the R3 model and how to look for it. I'm just gonna give a quick drawings here. When bullish, R3 model looks like this. Here's our run. Here's our short-term low. Inside our range, we have a raid that does not break below here. So I go to this low, and I'm looking at that. When I'm bearish, short-term high, inside my range, I'm looking for a raid that doesn't break this high. That's what I'm looking for. So this is bullish R3. This is bearish R3. Those are the things I'd be looking for. For the person that asks, there you are. Let's hop to M1 chart and then wrap up the call. Now let's go into the areas where we're actually finding the trade setups. First one was here. This fractal inside here. So look at this fractal here. Then look at this fractal here. Same fractal, the same delivery. Range, high probability order block, tags it, then move low. That's what's happening inside here. I'll drop to M1 chart. High, get rated. Dealing range. Run, game over. Why is this a dealing range? Because that's that run above highs. Short-term low is created. Then we run below the lows here. So my dealing range is here, here. High probability order block, here. 1, 2, 3 push. Short and above here is perfect. Okay. There's our run higher again. And there's your short. This is not a clear, as in there's not a lot of candles here, but this is the same thing again. There's that high, there's that push, there's my dealing range. High, low. That's my dealing range. So from here to here, there's my trade. Since this is not happening like this, meaning the dealing range is not being created before this high that had that last stop on. Let's draw another interpretation. So here, here, here is the first one. Dealing range was created like that. There to there. The dealing range here is being formed above the low that was created before this. So let's say there was a low here or something like that. My dealing range is still above the high where liquidity was resting. Here, we have push like this inside right here. Dealing range was created like this below this low. These are two different scenarios. Let's just put a box around them. That's a scenario where you can get an entry and possibly a second entry. This is a scenario here where you can use a fib, get in, and game over. Now that should stand out to everyone as, oops, type 1
Type 2.
and type 2. So all the things that I've shown you before, this is one way of putting them together. Just pay attention to where the range or the dealing range is being created. That gives you a measure of prognostication. So I'm not trolling, guys, but that was I learned that from man himself. So yeah, if you take a look at ranges when they're created like that, particularly dealing ranges, you'll always get an idea of when probability is on your side. And we could cycle through a lot of charts. We could go so far as to go to the start of the accumulation. Oh, this fractal is not finished then. To the end, I want to say here. Lowest closing down candle is here. You could frame fractals around this. Find the start of the accumulation and the stop point. Once you get the high, you can see where the delivery fractal is going to be by just seeing the accumulation, the stop point, and the last run above the high here. You can frame a range just like that, because this is the last run on sell side. This is the last run on buy side. So this is a dealing range. So inside here, all you have to do is look for areas that price could be drawn to. Imbalances, failure swings. You could play this range for as long as possible when you factor in time. If you are lucky, you'll get R3 setups. It don't always happen, but it can happen. So if I was bullish here, I'd want to run below one of these lows that doesn't break outside of the range. And once it goes above, I buy. All right, so let's entertain that for a moment. Find that opening price. When is that low rated? Let's find the low. Low is there. Rated here, goes above. It's a buy. Logical buy. Would you buy here and put your stop at this line? Of course not. So this wouldn't have taken you out. These are on higher. When did we close it? When did we raid this one? We rated that low. Let's take it off. Put it here. This is enough for a raid for me. So when it goes above that opening price, after the raid right here, these are things that we can buy. I don't know if this went lower first or it was a wild candle, but that would have been a nice run higher. Same thing inside here. We're coming down. Look at your short-term highs whenever they're created and if they get rated. This got rated here. Didn't come back to it. That's fine. No setup, no trade. No, oh my God, it didn't give me a trade idea. No setup, no trade. Just simple. There, got rated. Did it come back? Nope. Same idea. No setup, no trade. But I would beg to differ that most persons would see this right here through this lens. Where this was rated here. So we're now looking at that opening price. Rate it. This would have been a short. I want to say this is a short based on the rules. In
I
out done.
shorted that.
You shorted this?
You see the first touch back into the zoom model?
Right here?
No, on the right. You see where it's at right now?
Mhm.
The leg previous before the current one. That one. I saw that.
Oh, yeah. Same price level.
Yeah.
Tags it. runs low, we can always see our
And I
failure
sold the
swing.
one. I sold the one at the opening of 9:30, but then I got chopped up.
Wait, why would you sell in the discount end of a dealing range that has not been broken to the downside? See,
No, you see the first touch on the order block
here?
there.
Oh, ouch. Where was your
Yeah,
stop?
my stop was above that right there. Yep, I got stopped and then I just entered again.
Oh, spreads.
Yeah, spreads
Probably-
killed
yeah,
me
yeah,
and then
yeah,
I got
yeah.
entered
I
again.
sold in here and got stopped.
Ouch. I sold in here and I took partials.
I got stopped, right? That's it, I got stopped, right?
Yeah, I
Yeah.
mean, you
It
can't.
was pretty with the London Fair Value, like so London. I literally sold this because of the London Fair Value.
I wasn't even thinking about London Fair Value at the time. I just looked for
Look
the
how
rate
beautiful
at the
that
time.
was. And then you
Yeah.
have the zoom model right there.
Yeah, I was looking for the rate and then I went to a lower time frame, look for a zoom model here, and I got it. But then 10 o'clock, just boom on M1. If you want M1,
I got 50 points from both trades.
Nice and easy. Nice and easy.
Nice.
I was supposed to do a video yesterday, guys. I was going to break down 2 fractals that happened on NAS very recently. NAS H1. Here, this fractal studied this. It's June 1st to 13th H1 delivery.
Mm-hmm.
Then here again, 21st to the 30th delivery. This fractal, and what we talked about today, has a lot of things in common. We could go as far back on H1 and look at the spectacular sell-off that happened on NAS here. Same fractal, just more parts, which we know as something that we won't say. But yeah, delivery and the fractal, that's it. So when you look at the dealing ranges and you assume that every push that breaks a high is possible to create a dealing range, you get less inclined to anticipate weird stuff. You get more patient with your entries and your setups, and you start understanding why price did certain things in the past. And there's your run. Beautiful, beautiful, beautiful. We could take this portion of price right here, and that could be another fractal. Accumulation, stop hunt, dealing range. My fib. Perfect. Notice at 50% of the dealing range, we had this huge impulse taken below a low. Order block, expansion, FVG, liquidity, order pairing, short.
1, 2, 3 push.
Nice and easy. Nice and easy. And again, if you take a look at this high and where the low was, and you watch where the dealing range is created, you start seeing when you're likely to get a deep retracement than a not deep retracement. But that's going to be it for this one, guys. Hopefully that helps too.
This video is packed
With sauce, yes, but I also don't understand.
Definitely watching this.
All right, so let's talk in the group. Enjoy the rest of your trading day.
Done.